235 million ounces of paper silver claims, 76 million ounces of registered physical supply. That is not a rounding error. That is a structural gap that the paper market has not priced yet. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Gold is at 4,398 this morning. Silver is back above $80. The Fed Chair confirmation hearing is live right now. And the Iran ceasefire expires today. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. COMEX silver vaults. According to Blowfin Research and Finance Magnates, registered silver inventory, the metal with warrants attached, immediately deliverable against futures contracts, stands at approximately 76 million ounces as of late March 2026. Against total silver futures open interest of approximately 576 million ounces, that produces a coverage ratio of 13.4%. The exchange stress threshold is 15%. The data is already below it. According to goldsilver.ai, the May 2026 first notice day is 8 business days away. 47,034 contracts are still open. That represents 235.2 million ounces of paper claims. Physical pressure is classified as high. Now sit with that sequence. 8 business days, 235 million paper ounces, 76 million physical ounces. The timing is what deserves scrutiny, not the number. The timing. Think about what that sequence actually means. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time COMEX registered silver coverage dropped below 15%, silver was in the early stages of a move that took it from $26 to $30 within weeks. Today, the coverage ratio is 13.4%, and the Shanghai premium is running at 13.6% simultaneously. The data is already telling you something. Let's build it out. Now let's build the full picture because the COMEX vault data does not exist in a vacuum. According to goldsilver.ai and findbullionprices.com using Shanghai Gold Exchange official benchmark data, Shanghai silver is trading at 90.39 per ounce. Western spot, the XAG USD rate, is at 79.57. That is a premium of 10.82 per ounce, 13.6%. The 6-month average premium on the SGE is 9.72%. Today's reading is running more than 40% above that average. The most recent SGE official fix from April 17th confirmed AM premium of 9.4% and PM premium of 10.3%, with USD to CNY conversion at 6.8223. According to the Silver Institute, 2026 marks the 6th consecutive annual supply deficit in silver, projected at 67 million ounces this year alone. According to finance magnates, China's silver imports reached their highest level in 8 years in early 2026. According to Trading Economics, the U.S. 10-year Treasury yield is holding at 4.25 to 4.27%, near a one-month low, while the U.S. dollar index, per Yahoo Finance, sits between 98.10 and 98.39, below 100. That matters. The rate of physical drawdown from COMEX is not slowing. It is compounding against a backdrop of record Chinese import demand and a 6th straight year of supply deficit. The data is doing the talking. The ones who have been called alarmists for pointing at the coverage ratio, they are not saying much right now. And here is what makes that picture even harder to ignore. 576 million ounces of open interest, 76 million ounces of registered supply, a 13.6% Shanghai premium running 40% above its own 6-month average, a Silver Institute deficit of 67 million ounces projected for this year alone. At the same time, the US dollar index is below 100, the 10-year yield is near a one-month low, and the Fed is on hold at 3.50 to 3.75%. That is not a contradiction. That is the setup. A structurally tight physical market with macro conditions that have historically supported metals pricing. And before anyone takes that as a green light, setups can take a long time to resolve. Delivery month pressure does not automatically translate to a squeeze. Eligible to registered conversions can buy time. Cash settlements can absorb demand without price discovery. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Now the macro variable, because today it is not a backdrop. Today it is the primary variable. Here is the number most people are not running. 47,034 May contracts, 8 business days to first notice day, 235.2 million ounces, against 76 million ounces of registered supply. That is the math before we even get to geopolitics. According to Bloomberg, the Senate Banking Committee confirmation hearing for Kevin Warsh, President Trump's nominee for Federal Reserve Chair, is scheduled at 10 a.m. today, April 21st. According to CNBC, Warsh has committed to fighting inflation as his primary mandate. His exact language: the Fed must stay in its lane. Markets have priced him as a moderate hawk. If his testimony reads more aggressive than expected, the DXY bounces above 100 and metals face immediate headwind. If his tone is measured or conditional, the key obstacle to gold's next leg higher is removed. Now, layer in the Iran ceasefire. According to Trading Economics, on Sunday, the United States seized an Iranian cargo vessel attempting to breach the naval blockade. Tehran vowed retaliation. The ceasefire, which had held the Strait of Hormuz partially open, expires today. If the strait closes again, oil reprices immediately. Inflation expectations reprice immediately, and metals that have been held down by rate hike fears reprice in the same session. That is the historical pattern. Every time a Hormuz disruption has escalated, energy and hard assets have not responded slowly. It has not been different yet. Now the price read and the honest picture. Gold Western Spot is at approximately $4,198 to $4,109 per ounce this morning, per investing.com and Trading Economics. The prior close was $4,130. On Monday, gold drew down 2% intraday before recovering to close near $4,809. That recovery matters. A 2% intraday draw that does not result in a closing breakdown is institutional bid support, not weakness. Silver Western Spot is at $80.06 per investing.com with a session range of $79.65 to $80.21. Shanghai Silver is at $90.39, a $10.82 premium. If Warsh testimony holds below a hawkish threshold and the DXY stays under 99, gold has room toward $4,900 and silver has room to test $85 plus. If Warsh delivers aggressive balance sheet reduction signals and DXY reclaims 100, gold pulls toward $4,650 and silver retreats to the $74 to $76 range. That is the only short-term read that matters right now. As for trading the intraday move, I cannot see a clean picture on the lower time frames right now. I cannot tell you what silver does tomorrow. Nobody can. With a live geopolitical event, a live confirmation hearing, and a futures expiry window all converging on the same session, sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. 1. Warsh delivers an aggressively hawkish testimony today, DXY reclaims 100, and metals reprice lower by 4 to 6% within 48 hours. 2. COMEX open interest rolls aggressively before first notice day, alleviating delivery pressure without a physical squeeze. 3. An unexpected U.S.-Iran deal extension removes the Hormuz risk premium from oil and metals simultaneously. The bull case is equally real. 1. The 13.4% COMEX coverage ratio triggers physical delivery stress through the May expiry window, forcing paper-to-physical repricing. 2. The 10-82 Shanghai premium sustains above its 6-month average, confirming that Asian physical demand is structurally outpacing Western paper pricing. 3. The Silver Institute's 6th consecutive deficit year compounds against a COMEX vault draw that has removed roughly 1/3 of registered supply since September 2025. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one thing. The structural pressure is already built into these markets. The COMEX coverage ratio is below the stress threshold. The Shanghai premium is running 40% above its own average. The deficit is in its 6th year. The only question is whether the paper market catches up to what the physical market already knows, and whether it happens through this delivery cycle or the next one. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group official warehouse reports at cmegroup.com. Shanghai Gold Exchange benchmark data at sge.com.cn. Silver Institute supply and demand data at silverinstitute.org. Logic over hype. Always. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. If this analysis added value, like this video right now, subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. OG John AG 1.0, out.